JAKK Q3 breakdown, what does it mean for the stock? I'm a little late on this video. You guys have to understand Substack's my first priority. Many of them pay me. You don't have to see the questions that they ask answered. If you commented in the TikToks, I tried to give you a quick brief and then send you back over there. Basically, worse than expected results, that's for sure. Analysts basically had it right. And what I missed was that these orders are being pushed back multiple months. And what that doesn't allow is an early read on the consumer for this year. What do they like? What should they order more of? The CEO Berman on the call said a lot of orders that usually come in August came in October, which is great. That's for Q4. Q4 should be fine. What I did really like was the management commentary. If you go back to the Q2 earnings call, it was the most uninspiring thing of all time. This time, the CEO and the EVP laid out the groundwork, talking about how conservative they're playing. This was a quote I really liked. We're not going to play hero ball in order to make numbers, meaning they're not going to expand inventories, not knowing if those inventories are going to go down in value because tariffs come off, or if they're going to have to pay more, the retailers are going to have to pay more because of tariffs. It is kind of a clusterfuck. And they talked about that as a exercise in patience this year. So now you have a company trading at over a 5% dividend yield at a forward PE multiple, as they were just emphasizing the normalization that's going to happen in 2026 and the acceleration in 2027 to a business that they've never had before. This is typically a very stable business. They know what they're good at, they execute, that's it. They are really exciting about the partnerships that they've never had before. Additionally, because everyone in the space is struggling, they're going to be looking for opportunities in January and February of next year to expand their business, buying cheap companies or maybe making good deals because people just need the money and they are cash secure with little to no debt on their balance sheet. My thesis is essentially pushed back a quarter, but I do think the market's going to start appreciating it maybe a little bit before. It takes patience. A good investor has patience. But the great thing about this patience is you get paid 5% dividend yields, better than a 10-year. What we saw in trading action, super low liquidity after hours trading, like 15,000 shares, really nothing. And most of those came directly after the print. Then one of my guys on Substack got stopped out at the bottom, and it just went basically straight up the entire trading day, moving $1.50. And I think a large part of that is there were really no sellers. Just looking at the tape, there's not this selling onslaught at all. And 5% of the company sold short. Maybe the shorts, you could say, are correct about the business for this year. It was going to be an awful quarter, and it was. Down 34% revenue, and this is a stable business. That is objectively a really bad print. And yet, they still earned $1.80 in EPS. That's how cheap this thing is. A company that's trading at $17 that would earn $1.80 over the full course of the year, that would be a really cheap company. This was one quarter. So that 5% of short floor, again, this is what they're waiting for. They had to cover. They have to cover. You can't wait for another quarter and just be well, maybe that one's going to be, it's not going to be even worse. The management said a lot of Q3 is going to be in Q4. The full year is not going to look the same. Let's look forward to 2026. The bear thesis is completely played out. And they emphasize that this is a fundamentals bottom in the business. And if you're buying just this, if you were to buy 2025 in this business, it would be cheap. Go forward to 2025 by looking at, 2026 by looking at 2024. And you're this is just stupid cheap. You're talking about a company that's going to pay you over 5% dividend yield and probably double to still be cheap. If I told you that, you would be very excited. The problem is that I thought it was going to happen. We're going to see the inflection point now, and then this narrative was just going to catch up along with a short squeeze. What you're going to see is short covering, not at a loss. They are making money, but they cannot possibly afford to keep this short position on, pay 25 cents in dividend for another quarter just to hope that something crazy happens. The bear thesis is played out. The stock is a buy, 16 to 17 bucks, I believe. I said there was $2 of downside in this story, and that's pretty much exactly where it opened, and it rallied. It's only down $1 And that kind of shows you, like, this is the worst print that they could have possibly had. And the result is they're only down $1 and the price action looks good. If you want better articulated thoughts, please head over to my Substack. If you want a more rapid reaction time, please head over to my Substack. You don't even need to pay to get a better response time than I will put here on TikTok.